Everyone's been asking me about buying investment property in Mudgee for some reason. And so in this session, I'm going to go through a bit of a deep dive around Mudgee investment property, the performance, leading indicators, and a bit of a case study as well. My name is Mudgee. I'm a qualified property investment advisor with the Property Investment Professionals of Australia. I'm degree qualified in financial planning. I've spent 12 years in financial planning, and I've spent the last few years as a buyer's agent, specializing in investment property. The biggest issue I find people make when it comes to investing in property is they don't know what they're investing in. They have shiny object syndrome. They follow other people. They seek unqualified and inexperienced advice. And then it actually causes them to lose money in the long run. So by doing these deep dives, I'm seeking to increase your financial literacy. So do me a big favor and hit subscribe. And then that way you can learn more about investing in property across Australia. Before we move on, just a bit of an advice disclaimer. Anything that we go through is not financial advice. Please do yourself a favor and seek personalized professional financial advice. Speak to a mortgage broker, legal professional, accountant, and just understand if investing in property is appropriate for your situation. So a lot of people have been talking about investing in Mudgee because the New South Wales government were looking at increasing the renewable energy in the area through a bunch of solar farms and wind farms. Now this is way back in 2020, so more than 5 years ago now. And I get that people thought that this was going to increase property prices because of a number of infrastructure projects that were going up in the area. But as at February 2024, the ABC reported that Mudgee's population was going to grow by 40% as the renewable hub has grown itself, fueling concerns around housing shortage. So it was thought at the time that the population will grow by 10,000 people by the year 2026. So this was reported in February 2024, that more than 20 solar and wind farm projects in the Central West Orana area, along with the expansion of 3 nearby coal mines, was going to fuel population growth in the area. Now, over the past 10 years, 1,600 dwellings have been built, and it needed an additional 1,500 homes in the next 2 years. Fast forward, we're about 18 months down the track. Let's see what it's done to property prices in the area. So looking at a house value index, you can see here that nearby Dubbo has had an increase of 0 to 3% over the last 3 months. And then Narromine has increased by more than that, about 3 to 6%. If we have a look at Mudgee, house prices have actually fallen by, in some parts, between 0 and 3%, and then in the north by 3 to 6% decline in that particular area. So looking at a 3-month house value index, it's actually declined. Now, if we look at a 12-month home value index, you can see that nearby Dubbo has grown between 6 and 12%, Wellington between 0 and 6%, and then Mudgee between 0 and 6% as well. So the heat map indicates there that property prices haven't really grown that much in the last 12 months. When we have a look at asking property prices, you can see there that in 2020, we had a bit of a lull. And then as interest rates started to come down, that fueled property prices here. But again, house prices have stabilized over that period. So you can see there between halfway through 2022, house prices haven't really moved much. There's been some fluctuation, but it's been a very gradual trend, you can see here. So over the past couple of years, we've moved from an overall median price of around about 750 to just over 800 there, 800, 820, 850, something like that. If we look at the total property listings on the market, the number of property listings has actually come up since 2022. So you can see the stabilization there. As listings came down, that's when you saw that fuel in property prices, okay? And then we had that stabilization. And this is namely because the number of listings came up in the area. Now you can see that there is a general upward trend in the number of property listings, which is actually putting downward pressure on property prices here as well. In addition, vacancy rates are massive in this area. So vacancy rates at the moment are anywhere between 3 and 4% at the moment. So the Australian average at the moment is a roughly 1.5%. So round about here. You'll hear a number of investors saying 2% is a good benchmark, okay? So anything less than 2% indicates that it's a good vacancy rate benchmark. But the volatility that you can see here in vacancy rates is massive from period to period. And it can be as high as 8% in some instances, especially around 2015, 2016, 17. And more recently in 2025, we had vacancy rates at around 6% here as well. vacancy rates are starting to come down. However, they're still at pretty high levels, being 3.5%, which is based on the current averages that we're seeing. It's relatively high. The number of rental listings as well, they match vacancy rates here as well. So we're in a couple of periods where the number of rental listings are at highs as well. Not exactly all-time highs. We're not seeing sort of 125 rental listings like there was in 2015, but they are still a high amount of rental listings. You can see the number of rental listings trending downward now. That could indicate that rental prices are on the up and they're under some price pressure. So that would match the actual vacancy rates that we're seeing here as well. And we may see some rental growth in the near future. If we look at rental growth rates, rents have actually come down in a period here. When we look at the all houses metric, you can see rents have come down. They peaked at around about $800 per week. But now you can see rents are around about the $600 mark. They are starting to come up somewhat. There is some rental pressure here. However, rents have largely settled from anywhere between $800 and $700 in this 2024 period here. And then we're looking at around about mid to low sixes there. This is a case study of a property that has sold in Mudgee recently. The median price for property in Mudgee is around about $720,000 now. It's sold for $745,000, so it's fairly close to the median. It's a 3-bed, 2-bath, 2-car property that sits on 731 squares. Stamp duty and upfront costs for something like this is around about your $30,000. Now, based on a gross rental yield of 4.3% in the area, something like this will rent out for just under $600 per week, okay? Not accounting for the condition of the property or anything along those lines, but as a rough rental average, you're looking at around about $600 per week. Estimated council, water and landlord, $2,500, $800 and $2,500 for home and contents, depending on a few bits and pieces like where it's situated, what your security measures are, things like that. I encourage you to get your own quote every property that you look at. And then property management expenses are an average of 8.8%. In some areas, you're going to see property management costs of around about 10%, especially in coastal and regional areas. But in other areas, you can see property management's as low as 5.5%. So I use 8.8 as a rough. 80% interest-only payments based on 6% is just under $3,000 a month. So overall, if you do the math on something like this, you put down 20%, you pay your upfronts, you're looking at $174,000 in deposit and upfront funds. And then your ongoing costs based on these rough estimates here, you're looking at roughly $1,000 a month or $233 per week. So if we whack some of these figures into our portfolio projection tool that we have here, assuming expenses grow at 4%, your capital growth is at 6%, your rental growth is at 6%, and your loan interest is at 6%. So very conservative figures here. 720, let's put the property value, we'll use this one as an example. Rental at 595, and then a starting loan balance of 576. We're going to assume 10,500 in expenses, which is the figures that we had there, plus about $2,000 worth of incidental maintenance requirements or any incidental repairs that is required. So I use that as a bit of a buffer. It might also include land tax, depending on your financial situation as well. This property here, you will be in deficit for 8 years until the property starts to give you a bit of a return based on an interest-only loan here as well. And then you're not going to be able to achieve enough equity to cash out that equity and reinvest that into another property until around about 2032 or 2031. So it's going to take you a good 5 years to achieve that usable equity there. So you can see here from the graph, our usable equity isn't at a situation where we can reinvest it until around about 2031, where we can take that money out and use it to purchase something potentially at about the 500 mark, okay, accounting for your stamp duty and upfront costs there. And then your cash flow won't reach equilibrium until around about 2033, 2034, okay? So 2034, we have equilibrium, and then 2033, you're in deficit somewhat. Now, this is before any tax depreciation or negative gearing tax incentives as well. So you need to consider that upon your own financial situation. So thank you everybody for watching. I hope you've taken something about this. This was a deep dive into why you shouldn't buy in Mudgee. A lot of people have been asking me about this for some reason. I think it's on the back of that mini infrastructure boom in and around Mudgee. At this stage, I don't really see it. Prices have been flatlining. There's a large amount of stock on the market. There's long vacancy rates. And overall, you're going to be in big deficit, and it's going to take you roughly 6 or 7 years before you can take out that equity, assuming average growth rates to go again. And even then, you'll be in deficit for a few years after that.